Climate risk isn't just some far-off environmental headline anymore. It's a real and present danger to our entire financial system. We're actually seeing how a single heat wave can trigger a domino effect that messes with everything from your retirement fund to what you pay for groceries. So how in the world do we get a handle on it? Well, in this explainer, we're going to do just that. We're breaking down the super complex world of climate risk into parts you can actually understand, measure, and most importantly, manage.
So here's our game plan. First, we're going to follow the money, tracing the path from a storm brewing way out on the horizon to a real shock in the financial system. Then, we'll zoom in and get specific, dissecting climate risk into 6 key types. After that, we'll get into the numbers. How do you actually put a price tag on this stuff? And finally, we'll look at the playbook that companies are starting to use to navigate this wild new reality.
All right, let's jump right in. How does a hurricane in the Gulf of Mexico end up as a number on a company's balance sheet in, say, London? That's the connection we're about to explore.
I mean, it sounds a little dramatic, doesn't it? But this is the exact question that is literally keeping central bankers and huge investors awake at night. The real threat here isn't just one storm hitting one place. Nope, it's the sneaky chain reaction, the financial fallout that can be set off by all sorts of climate events.
And this is where this idea of transmission channels comes into play. You should think of it like a financial virus. Central banks have spent a ton of time mapping out how these climate events just refuse to stay in their lane. A physical event, like a massive flood, or what's called a transition event, like a surprise carbon tax, creates these financial ripples that spread from one company to the next, and pretty soon, they can swallow the whole system.
And this whole thing operates on 2 different levels. On the micro level, you've got individual companies and families taking a direct hit. We're talking property damage, businesses being shut down. But, when you get enough of these small shocks piling up, they start to scale. That's when you get to the macro level. You start seeing prices shift across the board, overall productivity drops, and you get that financial contagion we just talked about, which can seriously threaten the stability of the entire economy.
Okay, so now we get how the risk travels through the system. Let's get a little more granular. We're going to break down this massive challenge into 6 distinct types of risk that, frankly, businesses and investors are scrambling to get a handle on.
First up, we've got operational risk. This one's the most straightforward, really. It's the risk that climate change is just going to directly interfere with a company's ability to do its day-to-day business. And this risk is coming at you from 2 different directions. You've got the physical risks, the ones you can see and feel. A hurricane literally ripping the roof off a factory, or a brutal heat wave that just tanks worker productivity. But then you have transition risks, and these can be just as bad. Imagine a new environmental law gets passed basically overnight, and it forces a key factory to shut down, effective immediately. That's a massive operational blow.
Next up is credit risk. And oh man, this is a huge one for the entire banking industry. Simply put, it's the risk that a borrower, could be a company, could be a person, just won't be able to pay back their loan because of some climate-related financial disaster.
So how does this actually look in finance speak? Well, a physical risk, like a flood that damages a business, hits its revenue directly. That increases its probability of default. On the flip side, a transition risk can create what are called stranded assets. Think of a coal power plant. In a world that's going all in on renewables, that asset is suddenly worthless. This crushes the value of the collateral that was backing a loan, which increases the bank's loss given default if that borrower goes under.
Okay, let's tackle the next 2 together, liquidity risk and underwriting risk. One is all about sudden shocks to the market, and the other is about the rising price or even the complete disappearance of insurance.
So a sudden climate catastrophe can trigger a total market panic. That creates a liquidity crunch where it becomes almost impossible to sell assets for a fair price. And at the exact same time, that safety net we've all counted on, insurance, is starting to look pretty thin. More physical disasters mean higher premiums, obviously. But here's the real kicker. Transition risk can make some things, like running a coal plant, completely uninsurable, period.
And that brings us to the last 2, the real big picture risks. Market risk, which can hit entire classes of assets, and sovereign risk, which can threaten the financial health of a whole country.
Market risk is what happens when investors all at once have a collective aha moment and start pricing climate impacts into absolutely everything. Stocks, bonds, you name it. And sovereign risk? That's when a country's entire financial stability is teetering on the edge. This can happen in nations that are super vulnerable to climate change, like Bangladesh, or even to countries whose entire national budget depends on selling fossil fuels.
So, here's the million-dollar question. Which of these can actually cause an economy-wide crisis? As you can see here, while operational risk tends to be more contained, credit, liquidity, underwriting, and market risks all have a really significant potential to go systemic. And that is how a climate problem becomes a huge financial stability problem.
All right, so we've identified the risks. We've put names to the monsters. But, that's only half the fight. Now comes the really hard part. How do we actually measure them? How do we turn these scary ideas into cold, hard numbers?
Well, for transition risk, it all begins with measuring greenhouse gas emissions. The gold standard for this is called the GHG protocol. Scope 1 is the easy part, emissions from your own factories and trucks. Scope 2 is from the energy you buy. But Scope 3, now that's the big one. It's the whole shebang, everything else, from your supplier's emissions all the way to what happens when your customers actually use your product. Okay, once you've got the data, you need a metric. And one of the most important new tools is called Climate Value at Risk, or Climate VAR. Its entire job is to answer one question. If things go really, really bad, how much money could we lose? It's designed to put a dollar figure on a worst-case scenario. And here's the key to understanding it. Climate VAR isn't about predicting what's most likely to happen. No, it's about stress testing for the worst plausible things that could happen. By focusing on that bottom 5% of possibilities, it helps us wrap our heads around something called tail risk, that small but very, very real chance of a catastrophic financial loss.
So, we've named the risks. We have tools to measure them. Now let's get practical. What are companies actually doing about all this? It's time to open up the management playbook.
And here's a fantastic real-world example. A lot of firms are using what's called an enterprise risk management, or ERM, framework. The banking giant ING, for example, uses a 3 lines of defense model. The first line, that's the staff on the front lines, the people making the deals. The second line is a group of specialized risk committees who analyze everything the frontline flags. And that third line is internal audit, which basically acts as a final check to make sure the whole system is working like it's supposed to.
Here's another great example of managing that operational risk we talked about. The tech company Infosys realized that water scarcity was a major threat to their business. So what did they do? They built a pretty simple but super effective monitoring system. They track things like the local water table level and how much water they have stored on campus. If any of those things cross the line they've already set, management gets an automatic alert to do something about it. It's simple, but it works.
So at the end of the day, after all the identifying and measuring is done, a company really has 5 basic strategic moves. They can just accept the risk. They can try to avoid it, maybe by getting out of a certain business. They could even pursue it if they see an opportunity hiding in there. They can work to reduce it, or they can share it, which usually means buying insurance.
So look at that. In just a few minutes, we've gone from this abstract threat to a whole set of concrete financial tools and management strategies. The tools to measure and manage climate risk, they're not some futuristic idea anymore. They're here right now. And that leaves us with one last massive question. It's not a technical problem anymore. It's a question of accountability. Now that we can do this, who is actually responsible for acting on this information? Is it the companies themselves, the investors who give them money, or the regulators who write the rules? That's the critical conversation that all these new tools have finally unlocked.